Piper Aircraft has filed for bankruptcy protection not once, but twice. Two separate reorganizations, separated by years, each one with its own set of creditors, its own courtroom drama, its own headlines about what would become of one of the most recognized names in general aviation. And yet right now, in Vero Beach, Florida, there is a production line turning out new airplanes. The Piper name is still on the tail. The factory is still open. The company is still selling aircraft to flight schools and private buyers around the world. So the obvious question, the one that actually matters if you're thinking about buying a Piper, investing in anything connected to this industry, or just trying to understand how a manufacturer survives not one but two trips through federal bankruptcy court and comes out the other side still in business, is this. What does the financial picture actually look like right now? Not the press releases, not the airshow booth with the brochures and the cheerful sales rep, the actual balance sheet, the actual structure of the company, the actual debt load, the cash position, the ownership picture, and what all of it means for whether Piper is genuinely stable or whether there's a third chapter of this story still waiting to be written. That's exactly what we're walking through today. And if that kind of deep financial dive into the companies behind the aircraft you fly or are thinking about buying is the kind of thing you want more of, subscribe right now, because this is exactly what this channel is built around, and there's a lot more coming that you genuinely don't want to miss. Let's build this from the foundation because you cannot understand where Piper is today without understanding how it got here, and that history is more complicated, more painful, and more instructive than most people who casually know the brand realize. Piper Aircraft Corporation was founded in the 1930s, grew into one of the dominant forces in general aviation through the post-war boom years, and by the late 1970s and early 1980s was producing thousands of aircraft annually out of its Lock Haven, Pennsylvania facility and other locations. The Piper name meant something specific in that era: affordable, practical, honest airplanes for working pilots and flight training operations, a clear counterpoint to Cessna's similar volume play and Beechcraft's more premium positioning: Cubs, Cherokees, Archers, Senecas, Navajos, Cheyennes. The product line ran from basic two-seat trainers all the way up to pressurized turboprops, and at its peak the company was moving inventory at a rate that the current general aviation market would find almost unimaginable. Then the bottom fell out, not just for Piper, but for the entire general aviation industry, and the mechanism was liability. Product liability lawsuits against aircraft manufacturers began hitting in truly catastrophic numbers through the late 1970s and into the 1980s, and the exposure on aircraft that had been built and sold decades earlier was completely unbounded. A Cherokee built in 1965 that was involved in an accident in 1984 could still generate a lawsuit against Piper with eight-figure potential exposure, and by the time you multiplied that across thousands of aircraft and hundreds of active lawsuits in various stages of litigation, the insurance costs and the legal defense costs had grown into something that was actively strangling the manufacturing economics. Cessna famously stopped building piston singles entirely for a decade and a half. Piper didn't stop, but it couldn't generate enough revenue from new aircraft sales to stay ahead of what the liability tail was doing to the balance sheet. The first bankruptcy filing came in 1991. Piper Aircraft Corporation filed for Chapter 11 protection in January of that year, and the reorganization process that followed took years to resolve. The Vero Beach facility, which had become the primary manufacturing location after the 1972 closure and subsequent operations at Lock Haven ended, was the center of the reorganization fight, with various potential acquirers circling and the bankruptcy proceedings dragging through the early 1990s in a way that left employees, dealers, and parts suppliers in a genuinely difficult limbo. The General Aviation Revitalization Act of 1994, which established an 18-year statute of repose for aircraft manufacturers, essentially capping the liability exposure on older aircraft, came directly out of this era of industry-wide collapse, and it probably saved general aviation manufacturing in the United States in a very real sense. But by the time it passed and its effects started flowing through to manufacturers, Piper had already spent years in reorganization and had accumulated damage that would take a long time to work through. Piper emerged from that first bankruptcy under new ownership, acquired by a group that included Newco, connected to Teledyne Continental Motors at various stages, and the company restarted production and tried to rebuild the dealer network and the product line through the mid to late 1990s. But the financial footing coming out of a prolonged bankruptcy reorganization in an industry that was itself still rebuilding from the liability crisis was never as solid as the optimistic press releases of that era suggested. The company was carrying the weight of the reorganization, navigating a market that was a fraction of its pre-crisis size, and trying to develop new products and certify new aircraft at a time when the certification process was getting more expensive and more time-consuming with each passing regulatory cycle. The second bankruptcy filing came in 2008. This one was different in character from the first. The 2008 filing came in the context of a global financial crisis that was cratering demand for discretionary capital goods across every category, and Piper was not uniquely positioned to weather a sudden, severe drop in new aircraft orders when its financial cushion was already thin. The company filed for Chapter 11 again in May of 2008, and this reorganization led to the acquisition of Piper by a new set of owners, ultimately involving significant investment from groups with connections to Central and South American aviation markets, which has shaped the company's strategy and customer focus in ways that continue to matter today. The current owner of Piper Aircraft is the Imprimis Group, which is connected to a network of investors with interests in aviation and aviation training across multiple countries and regions. The ownership structure today is meaningfully different from anything Piper had during its publicly traded or domestically focused private equity phases, and understanding who owns the company and what they're actually trying to accomplish with it is critical to reading the balance sheet correctly, because a balance sheet doesn't tell you much unless you know what the owners are optimizing for. So what is the actual financial structure of Piper Aircraft right now? Here is where we have to be precise about what we can and cannot know with certainty, because Piper is a privately held company. It does not file public financial statements with the Securities and Exchange Commission. It does not publish quarterly earnings releases. There are no analyst calls where management walks through revenue, gross margin, and capital expenditure in public view. What we have is a combination of data points: FAA production records, which give us aircraft delivery numbers, financial disclosures made in connection with various certifications and regulatory filings, information that has come out in litigation and court proceedings over the years, industry analyst reporting and trade publication coverage, and the structural inferences you can draw from publicly visible facts about the company's operations, product line, and market position. Starting with production volume, because that's the most objective baseline we can establish. FAA aircraft certification records show us how many new aircraft Piper is actually delivering each year. And those numbers tell a story that is simultaneously more modest than the company's marketing materials suggest, and more resilient than you might expect from a company that has been through 2 bankruptcy reorganizations. Piper has been producing in the range of roughly 100 to 200 aircraft annually in recent years, depending on the year and the model mix, with the Pilot 100 and Pilot 100i, the current iteration of what used to be the Piper PA-28 Cherokee family, making up the bulk of the training fleet deliveries, and the Archer, Seneca, and M-Class piston singles and multi-engine aircraft making up most of the rest. Those numbers matter for understanding the revenue base, because at current new aircraft list prices, even at the lower end of that production range, you're looking at meaningful revenue. The Pilot 100i sells for roughly $200,000 or somewhat below at base pricing configured for flight training fleets, while the M600 SLS, Piper's flagship pressurized single at the top of the product line, is priced well north of $3 million, fully equipped with its Garmin avionics suite and the Halo safety system. The revenue per unit is therefore dramatically different depending on the product mix in any given year. And the M-Class aircraft, even though they represent a much smaller fraction of total units delivered, carry gross revenue numbers per unit that dwarf what the training fleet generates. The geographic distribution of Piper's customer base is a crucial piece of the financial picture that doesn't get discussed nearly as much as it should be. A very significant portion of Piper's current production goes to international customers, particularly flight training academies in Latin America, Europe, and the Asia-Pacific region, rather than to domestic U.S. buyers alone. This is a deliberate strategic orientation that has been shaped by the ownership's network and connections, and it matters for understanding both the revenue stability and the currency and geopolitical risk embedded in the current business model. A flight training academy in Brazil or Colombia, buying a fleet of Pilot 100i aircraft, is a very different customer than a U.S.-based fixed-base operator or a private buyer ordering a single Archer for personal use. And the dynamics of serving that international fleet customer well are different from what drove Piper's business model in its earlier American market-focused years. What this means in balance sheet terms is that Piper's revenue is diversified geographically in a way that provides some insulation from the specific slowdowns hitting domestic GA demand. the insurance crisis, the medical certificate headwinds, the used aircraft pricing pressure, all the things we've covered at length in other contexts. But it also creates exposure to currency fluctuation, export financing complexity, and political and economic instability in markets that have their own volatility characteristics. A major Brazilian training academy that's a core customer becomes a very different customer during a Brazilian currency crisis than it was when the real was strong, and managing that kind of international revenue concentration requires a level of financial sophistication and a balance sheet flexibility that Piper has had to build in ways that weren't necessary when most of its customers were writing checks in US dollars from US banks. Now let's talk about the debt structure, because this is where understanding the bankruptcy history becomes essential for reading the current position. When a company emerges from Chapter 11 reorganization, particularly when it's done it twice, the balance sheet that comes out the other side typically carries a set of legacy costs and structural features that reflect the negotiations and settlements made in the court process. Debt that gets restructured in bankruptcy tends to come out in forms that prioritize cash flow management over face value, extended maturities, renegotiated interest rates, converted equity, and negotiated settlements with various classes of creditors that collectively reduce the immediate cash burden at the cost of various other structural complications. What Piper's specific debt load looks like in precise dollar terms is not publicly disclosed at the level of granularity that would let you read it the way you'd read a public company's balance sheet. But there are structural facts we can infer with reasonable confidence from what we know. The company has had capital invested in it by the current ownership group that funded the post-2008 recovery, retooled the production facility, funded the development and FAA certification of the M600 and its Halo safety system, and maintained the production line through market cycles that have been genuinely difficult for everyone in general aviation. That capital represents real investment by real investors who have expectations about return, and understanding how those expectations interact with the company's revenue generation and cost structure is the key to reading the balance sheet correctly, even without having the precise document in hand. The Halo system, which is Piper's branded implementation of the Garmin Autoland system on the M600 SLS, is worth discussing specifically as a balance sheet item because it represents a genuinely significant investment in certification and development that Piper made during the 2010s, and that investment paid off in a meaningful way in terms of product differentiation. The M600 SLS was the first aircraft to be FAA certified with an autonomous emergency landing system, a system that can identify a suitable runway, plan and fly the approach, make radio calls, communicate with ATC, and land the airplane without any pilot input if the pilot is incapacitated. That is not a trivial engineering and certification achievement, and Piper paid real money in engineering resources, FOB-DUR time, test flights, and regulatory engagement to get it certified. The fact that they got there, and got there first, tells you something about the functional capacity of the engineering organization and about the willingness of the ownership to invest in the premium end of the product line rather than just managing the training fleet business in maintenance mode. That investment matters for the balance sheet in two directions. On the liability side, it represents development capital that was deployed and that the company needs to recover through unit sales over time. The classic situation where front-loaded certification investment needs to be amortized across enough future production volume to pencil out. On the asset side, the FAA type certificate for an aircraft with a certified autonomous landing system represents a genuine competitive moat, a barrier to entry that competitors cannot simply replicate without their own years-long and expensive certification journey. Type certificates in aviation are real assets with real value, and Piper's certificates, particularly the M600 CEST SLS certificate with the Halo system, are worth more than they were before that certification was achieved. Let's talk about the production facility, because real property and manufacturing infrastructure are major balance sheet line items for any manufacturer, and Piper's Vero Beach facility has its own interesting history. The main Vero Beach manufacturing campus has been Piper's home since the company relocated there from Lock Haven, and the facility has gone through cycles of expansion, consolidation, and modernization that roughly track the company's financial fortunes. In its peak production years, the facility was staffed at levels that the current business volume simply doesn't require, and one of the things that happened through both bankruptcy reorganizations was a right-sizing of the workforce and the facility footprint to match a much lower production rate than the original facility was designed for. The current state of the Vero Beach operation reflects a company that has made genuine investments in modernizing specific parts of the manufacturing process, while working within a facility that was originally designed for a much higher volume era. Some of the manufacturing infrastructure is modern, particularly around composite fabrication and avionics integration, where the company has invested to stay current with what buyers expect in new aircraft. Other parts of the facility show the age of a plant that has been through the financial cycles we've described, where investment dollars were not always available for every upgrade that would have been nice to have. This mixed state of the physical plant is actually pretty typical of what you find in general aviation manufacturing, where capital for facility improvement competes with capital for product development, certification, and working capital for parts and inventory, and the priority order shifts depending on what the business most urgently needs in any given period. What does working capital look like for an aircraft manufacturer of Piper's size and structure? This is worth unpacking because it's one of the more counterintuitive aspects of how these businesses actually function. Building an airplane is a capital-intensive process with a long cycle time. The raw materials, subassemblies, and purchase components for a given aircraft have to be paid for well before the completed airplane generates any revenue. A single M600 takes months to build from started production through completion, inspection, and delivery, and the parts and labor costs are carried as work-in-progress inventory on the balance sheet throughout that process. For a company producing at Piper's volume, the working capital tied up in production inventory at any given time is substantial, and managing that working capital efficiently, turning it into finished aircraft and delivered revenue quickly enough to keep cash flowing through the operation, is one of the core financial discipline challenges for any manufacturer in this space. Aircraft manufacturers also carry finished goods inventory, completed aircraft that have been built but not yet sold, and in the current environment, where we've talked extensively about new aircraft sitting on ramps longer than projected, the finished goods inventory question is a real one. Every completed aircraft sitting in Vero Beach waiting for a buyer represents cash that went into building it and has not yet come back, and the longer that airplane sits, the more the carrying cost of that inventory accumulates. How well Piper is managing this dynamic relative to the current demand environment is not something we have precise public data on, but the structural pressure is real and affects every manufacturer that builds to a production schedule rather than strictly to confirmed orders with deposits. The training fleet business, which is the volume backbone of Piper's current operation, has its own financial characteristics worth understanding. Flight training academies buying fleets of Pilot 100I aircraft are typically not paying full list price in cash. They're using financing, they're negotiating volume discounts, and they're often working within the financial structures of institutional buyers. Universities, government-backed training programs, airline cadet pipeline operators that have their own financing requirements and payment timing characteristics. Revenue recognition on a fleet deal is not the same as revenue recognition on a single private sale, and understanding how those fleet sales flow through the income statement and the balance sheet matters for understanding what the company's true financial position is at any point in the production cycle. The airline cadet training pipeline business has been a particularly important driver for Piper's training fleet demand over the last decade. As the pilot shortage became a genuine constraint on commercial airline expansion globally, the demand for structured training programs using modern, standardized equipment grew significantly, and Piper's training aircraft with their Garmin G1000 NXI avionics and consistent build quality fit well into the needs of organized cadet programs that needed to take large numbers of students through standardized instrument training efficiently. This is a fundamentally different customer than the individual private pilot who buys a used Cherokee to fly on weekends, and serving it well requires a different kind of sales and support infrastructure, fleet support contracts, parts availability commitments, training documentation, and ongoing relationship management at an institutional level that a company primarily organized around individual buyer relationships has to actively build and maintain. Whether the cadet pipeline demand holds at current levels is a genuine question for Piper's revenue forecast, because commercial aviation demand is cyclical in its own right, and the pilot shortage that drove intense demand for training aircraft could ease if economic conditions soften, airline growth slows, or retirements lag. This is a demand risk that sits in a different category from the retail buyer psychology risks affecting the used and new piston market. It's institutional rather than individual, cyclical rather than structural, and managed through contract relationships rather than one-at-a-time sales. But it's a real risk in the revenue picture, and a balance sheet reading that doesn't account for it is incomplete. Now let's look at the specific financial implications of the M-Series aircraft, because this is where Piper's financial future gets interesting, in ways that the training fleet story alone doesn't capture. The M600 SLS, the M500, and the broader M-Series lineup represent Piper's bet on the premium end of the piston single market, and the economics of these aircraft are dramatically different from the training fleet business. A single M600/SLS, at its current pricing, brings in revenue per unit that a fleet of Pilot 100i aircraft would take many sales to match, and the gross margin per unit, while not public, is presumably structured to reflect the premium positioning and the significant engineering investment that went into the Halo certification. The challenge for the M-Series financially is exactly what we discussed in other contexts when talking about new aircraft sales in the current environment. The buyer for a $3 million plus pressurized piston single is exactly the high net worth demographic that has gotten more cautious, is dealing with the same insurance headwinds, and has access to a very compelling used market alternative in the form of well-maintained used M-Series or competitive aircraft from other manufacturers. The Halo system provides genuine differentiation. There is no other aircraft in this price segment where you can push a red button and have the airplane land itself, and that capability has real market value for exactly the kind of pilot owner who is flying solo on instrument approaches in actual conditions and recognizes what it means to have that emergency backstop. But at the price point these aircraft carry, even compelling differentiation has limits, and the velocity of M-Series deliveries is constrained by the size of the buyer pool that can both afford the aircraft and navigate the insurance and training requirements to actually fly it. The insurance situation for M600 buyers specifically deserves its own moment, because it's more complex than a standard piston single insurance conversation. An M600 is a pressurized, high-performance, turbocharged single with a Garmin-controlled autopilot and a sophisticated avionics suite, and insuring one for a pilot without significant high performance and instrument time requires a detailed conversation with underwriters that doesn't always end with a quote the buyer was expecting. Some buyers get very good news. High-time, experienced, instrument-proficient pilots in good health can insure an M600 at rates that make the ownership economics genuinely favorable compared to alternatives. Others discover that the insurance requirement for meaningful turbine or complex time before solo operations or the annual premium on their current experience level changes the economics of the purchase significantly. Every one of those difficult insurance conversations is a potential lost sale, and at $3+ million per unit, even a handful of lost sales in a quarter represents meaningful revenue that didn't materialize from a production plan that assumed it would. Let's talk about the certification pipeline, because what a manufacturer has in the certification queue tells you something important about where they're allocating capital and what they're betting their future on. Piper has historically been relatively conservative about entirely new aircraft development compared to competitors who have pursued more aggressive clean sheet designs, and that conservatism has costs and benefits that both show up in the balance sheet. On the cost side, a manufacturer that isn't constantly certifying brand new airframes isn't spending as aggressively on the engineering and flight test resources required for original type certificates, which means lower capital expenditure in any given period. On the benefit side, that conservatism reduces the risk of a major development program going over budget or over timeline, which has killed more than one GA manufacturer that took on an ambitious clean sheet project without the financial cushion to absorb delays and cost overruns. Piper's current strategy looks more like continuous refinement of the existing certified product line, avionics updates, power plant improvements where feasible, interior and exterior modernization, and safety system additions like Halo, rather than entirely new airframe development. This is a financially lower-risk posture for a company that has been through 2 reorganizations and presumably doesn't have the kind of deep balance sheet cushion that would allow it to absorb a failed clean sheet development program. It also, however, limits the company's ability to address entirely new market segments or to respond to competitive threats that require genuinely new aircraft design rather than updated variants of existing certified platforms. The supplemental type certificate ecosystem around Piper's existing products matters here too. A significant industry has grown up around upgrading and modifying existing certified Piper airframes, avionics upgrades, engine conversions, structural modifications, interior refurbishments. And while Piper itself doesn't capture all of that aftermarket revenue directly, The existence of a robust modification and support ecosystem around your certified type certificates keeps those aircraft in operation longer, which supports parts demand, maintains brand visibility, and keeps the used aircraft value floor from collapsing in ways that would make new aircraft sales harder. The fact that there are still hundreds of thousands of Piper aircraft on the U.S. registry, many of them actively flying with upgraded panels and modern equipment, is a genuine asset for the brand, even if the financial benefits don't flow directly to the factory in Vero Beach in every case. The parts and service business is a balance sheet asset that often gets underweighted when people think about what Piper's financial position actually is. For every Cherokee, Archer, Seneca, Navajo, and M-Series aircraft actively flying anywhere in the world, there is ongoing demand for genuine Piper parts. Not aftermarket alternatives, but factory parts with Piper part numbers, required for various maintenance tasks, kept in stock by Piper distributors, and generating steady revenue that does not depend on selling a new airplane. The installed base of Piper aircraft globally is enormous, given the production volumes of the company's peak years, and even at a relatively modest margin per part, that installed base generates a revenue stream that continues regardless of new aircraft sales velocity. It's not the most exciting part of the business story, but it's genuinely important balance sheet context. A company with a large and active installed base has a revenue floor that a startup manufacturer simply doesn't have, and that floor provides some cushion against the fluctuations in new aircraft demand that we've been describing. How significant is that parts revenue in the total picture? Without precise internal financials, we can't put an exact number on it, but industry patterns from comparable manufacturers suggest that aftermarket parts and service for the installed base can represent a meaningful fraction of total revenue, sometimes 20 to 30% or more for a manufacturer, with Piper's combination of long history and large installed fleet. At that scale, it's not a rounding error. It's a genuine stabilizing element in the revenue mix that has mattered particularly in periods when new aircraft sales slowed. The warranty and product liability picture for Piper today is dramatically different from what it was in the 1980s and early 1990s that drove the first bankruptcy, and that difference is worth being explicit about because it's fundamental to understanding why the company is still in business and why it has a reasonable chance of staying that way. The General Aviation Revitalization Act has capped the tail liability on older aircraft, and the regulatory and legal environment, while still challenging, no longer creates the essentially unlimited retrospective exposure that made GA manufacturing financially existential for a period. Piper still carries product liability insurance, still faces individual product claims on its newer aircraft, and still has to manage quality and safety with the awareness that any manufacturing defect is both a safety problem and a legal problem. But the existential liability scenario that forced the 1991 filing is not the scenario the company is operating in today, and that matters for reading the current balance sheet with appropriate historical context. What about the competitive picture? Because Piper doesn't operate in isolation, and the balance sheet has to be read in the context of what the company is competing against for the buyers it's trying to serve. In the training fleet space, the primary competition is Textron Aviation, which owns the Cessna brand and produces the Skyhawk that has been the dominant training aircraft for decades, along with the Skyhawk's various updated iterations, including the current Cessna 172 models with glass cockpits. Textron is a large, diversified industrial company with a balance sheet that dwarfs anything Piper can bring to bear. They have the backing of a multi-billion-dollar parent with businesses in defense, industrial equipment, and other sectors, which gives them a financial cushion and a cost of capital that a standalone GA manufacturer simply cannot match. Competing against Cessna for training fleet business when your competitor has Textron's financial backing is a structural disadvantage that shows up in financing terms, in dealer support capability, in marketing spend, and in the ability to absorb a slow year without it becoming a crisis. In the premium piston single market, Piper's M-Series competes with Cirrus's SR-22 and the SR-22T at the upper end, and Cirrus has its own interesting financial story. Backed by Chinese aerospace conglomerate Canggay since its 2011 acquisition, that has given it a different kind of capital access than Piper's current ownership structure provides. Cirrus has outproduced and outsold Piper in the piston single market by a wide margin for years, and the Cirrus brand has developed a loyalty and a safety story around the parachute system that has become deeply embedded in how buyers think about premium piston singles. Competing against that positioning with the M600's Halo system is Piper's answer, and it's a legitimate answer, An autonomous landing system is in some ways a more complete safety solution than a ballistic parachute for certain scenarios. But Cirrus's market position, production volume, and brand recognition give it structural advantages that translate directly into financial advantages. Diamond Aircraft, Daher Kodiak, and other competitors in adjacent segments each add their own pressure at specific points in the product line, and understanding where Piper's pricing and positioning sits relative to each of those alternatives is part of how you read the balance sheet's asset side. Specifically, how durable are the revenue streams that support the business going forward, and how much pricing power does the company actually have versus having its pricing constrained by competitive alternatives that a buyer can choose instead. Now let's bring all of this together and talk about what the balance sheet actually shows in its broad structural terms, using everything we've built up to this point. On the asset side, Piper's balance sheet includes the Vero Beach manufacturing facility and associated real property, which represents real estate in a market that has been appreciating and that has genuine value independent of the manufacturing operations conducted there. It includes the type certificates for the current product line, PA-28 derivatives, the Seneca, the M-Series, which are FAA certified and carry value as manufacturing rights that a competitor would have to spend years and significant money to replicate. It includes the specific value of the Halo system certification on the M600's SLS, which is a genuine first-mover asset in a capability that hasn't been replicated by competitors yet. It includes the parts inventory and distribution network that supports the installed fleet. It includes the brand equity of the Piper name itself, which after nearly 90 years of production, even with 2 bankruptcies in the history, still carries recognition and meaning in the aviation world that translates into real commercial value. On the liability side, the post-reorganization capital structure includes whatever debt the ownership group used to fund the post-2008 recovery and subsequent operations. It includes the ongoing working capital financing required to maintain production inventory and support the cycle time between production start and delivery. It includes product liability insurance obligations and self-insurance reserves for warranty claims on current production. It includes the pension and benefit obligations, though these were restructured in the bankruptcy proceedings and are presumably in a different position than they were in the pre-bankruptcy era. And it includes all the ongoing operating obligations of a manufacturing company, supplier contracts, lease obligations, regulatory compliance costs, and the labor contracts that govern the workforce. The net picture, the equity value, if you will, though for a private company, equity value is a somewhat different concept than for a public one, reflects what the current ownership actually paid for the company, what they've invested since, and what they believe it's worth as a going concern generating the revenue streams we've described. The fact that the company has survived, maintained production, developed the Halo system to certification, and continued to serve both the training fleet and premium piston market for more than 15 years under the current ownership suggests that whatever the precise numbers are, the business has been generating enough cash to cover its obligations and keep the lights on without a third trip to bankruptcy court. That's not a trivial statement for a company with this history, and it shouldn't be taken as given. It reflects real operational management, real market discipline, and real decisions about what to invest in and what to let go. What are the key risks that could challenge this picture going forward? Several of them stand out clearly from everything we've walked through. The first is training fleet demand cyclicality. If the commercial aviation pilot demand that has been driving cadet training program growth softens, whether because airline expansion slows, because economic conditions deteriorate, because a new technology like AI flight systems changes the pilot demand picture more quickly than expected, or simply because the current crop of aviation training academies has absorbed the new aircraft they need for the near term, the volume backbone of Piper's current business faces real pressure. A drop in training fleet orders that isn't offset by M-Series demand or other revenue would put meaningful strain on the cash flow position. The second is the M-Series market dynamics. If the broader forces compressing new aircraft sales in the premium piston single space, insurance friction, used market competition, high interest rates, buyer caution, push M600 sales below what the production plan assumed, the revenue shortfall is significant per unit in a way that training fleet volume drops simply aren't. A couple of missed M600 deals in a quarter is not the same financially as a couple of missed Pilot 100i fleet sales, and managing production to actual demand in the premium segment without overbuilding expensive inventory is a discipline that matters enormously at this price point. The The third is currency and geopolitical risk in the international markets that now make up a significant portion of total revenue. Latin American economic and currency volatility is a real variable, and a period of significant currency depreciation in key markets or political disruption affecting international buyers' ability to close aircraft purchases could affect revenue timing and collection in ways that create working capital pressure, even if the underlying demand is still there in principle. The fourth is the competitive response from better capitalized rivals. Textron Aviation's backing from Textron Inc. and Cirrus's backing from Kaiga give those competitors financial resources to weather downturns, invest aggressively in new product development, and offer financing and support terms that a more thinly capitalized Piper simply cannot match. If either competitor makes a major product move into Piper's core segments, a new trainer at a price point below the Pilot 100i, or a premium piston single with capabilities competitive with the M600 at a lower price, Piper's ability to respond is constrained by its balance sheet in ways that its competitors' responses would not be. The fifth, and perhaps most interesting from a long-term perspective, is the technology transition question. Electric and hybrid electric propulsion is coming to the training fleet space, maybe not as quickly as the most optimistic projections suggested, as we've discussed at length, but the direction is clear. When viable electric trainers with sufficient range, adequate charging infrastructure, and compelling economics actually arrive in the market in volume, the calculus for a training academy choosing between a new conventional piston trainer and an electric alternative is going to change. Whether Piper has the capital and the strategic positioning to navigate that transition, whether that means developing their own electric or hybrid platform, partnering with a technology supplier, or finding some other way to stay relevant as the propulsion technology shifts, is a question that the current balance sheet has to eventually fund an answer to. None of these risks mean that a third bankruptcy filing is imminent, or even likely, in any reasonable near-term scenario. The company has navigated a lot of difficult years and emerged with a functioning production line, a coherent product strategy, and an ownership group that appears committed to the long-term aviation business, rather than looking for a quick exit. The Halo System certification, in particular, represents the kind of investment in genuine technological differentiation that you don't make if you're planning to wind the company down. You make it if you're serious about the premium end of the market and you believe you can own a meaningful position there. But the balance sheet of a company that has been through 2 reorganizations, that operates in a capital-intensive manufacturing business with high certification costs and cyclical demand, that competes against better capitalized rivals for its core customer base, and that carries the ongoing overhead of a manufacturing facility and workforce designed for a market that is substantially smaller than it was in the company's peak years, is not a balance sheet that provides the kind of cushion that allows for many significant missteps. There is not a lot of room for a development program that runs seriously over budget, a major quality issue that generates significant warranty or liability costs, a customer concentration problem if 1 or 2 major training academy customers run into their own financial difficulties, or a multi-year downturn in new aircraft demand across both the training and premium segments simultaneously. The company's history of emerging from difficulty and continuing to operate is real and genuinely impressive. But reading the current financial picture with honest eyes means acknowledging that impressive resilience is not the same as financial invulnerability, and that the structural challenges we've walked through, competition, capital constraints relative to rivals, technology transition, cyclical demand, insurance headwinds for premium buyers, don't disappear just because the company has survived them before. They require ongoing, active management and ongoing strategic investment that has to be funded from the same balance sheet we've been examining. For the practical question that is probably in your mind if you've stayed through all of this, whether that's as a flight school considering a Piper fleet order, as a private buyer evaluating an M600, as an A&P thinking about specializing in Piper maintenance, or as an industry observer trying to understand where this company fits in the broader GA landscape going forward, here is the honest summary that the financial picture actually supports. Piper is a going concern with a realistic path forward that doesn't require a third bankruptcy filing to write. The product line is coherent, the training fleet demand is real, the M-Series premium positioning has genuine technology differentiation behind it, the parts and service revenue base is stable, and the ownership appears committed to the long game in a way that post-bankruptcy ownership sometimes isn't. The company is not the massive volume producer it was in the 1960s and 1970s, and it's unlikely to become that again. The market it operates in today is structurally different from that era in ways that have nothing to do with Piper specifically and everything to do with the entire general aviation ecosystem. But a leaner, more focused Piper, oriented around the training fleet and the premium piston single market, with international customer diversification and a genuine safety technology story, is a viable business model in the current environment. The cautions are equally real. The competitive disadvantage relative to Textron and Cirrus in terms of financial backing is structural and ongoing. The technology transition in training aircraft propulsion is a genuine long-term challenge that requires a capital response the balance sheet may have limited room to fund. The M-Series buyer pool faces real headwinds from insurance dynamics, used aircraft competition, and buyer caution that make revenue from that segment less predictable than the production schedule would prefer. And 2 bankruptcies in the history are not something you simply forget about when evaluating counterparty risk, whether you're a dealer extending inventory, a training academy signing a fleet contract, or a private buyer thinking about parts support 20 years from now. What the balance sheet actually shows, in the most honest summary available to us from the outside, a company that has survived when it probably shouldn't have by conventional measures, that has been restructured enough times to carry significant scar tissue in its financial structure, that has made some genuinely smart bets on technology differentiation, that operates in a market that is hard for everyone right now, and harder for a thinly capitalized player than for the big names, and that has a realistic but not comfortable path to continued operation, and even modest growth if it executes well in its chosen segments. That's not a sexy conclusion. It's not the doom story, and it's not the triumph story. It's the honest story, which in finance is almost always more complicated than either of those simpler narratives, and usually more useful for making actual decisions. The Piper name has been on airplanes for nearly 90 years now. It has survived things that ended every other manufacturer of comparable stature that was building in the same era. Whether it makes it to 100 years depends on execution, on market conditions, and on the same discipline in matching production to real demand that every manufacturer in this space is struggling with right now. If the history tells you anything, it tells you that predicting this particular company's demise is a bet that has been wrong before, more than once, and usually by people who were reading a balance sheet without reading the full story behind it. That's the full picture. If this is the kind of deep financial analysis of the companies and the economics behind the aircraft you care about that you've been looking for, make sure you're subscribed right now, because there's a lot more of exactly this coming, and I'm going to keep pulling apart the financial reality of this industry in a way that the press releases and the airshow coverage simply never will. I'll see you on the next one.